There is a battle happening right now in Washington, D.C. that will determine whether trillions of dollars flow into crypto markets or whether banks successfully block it for years. On one side, Coinbase, Ripple, Circle, and over 120 crypto firms backed by the full lobbying weight of the blockchain industry. On the other side, JP Morgan, Bank of America, and the traditional banking establishment, quietly but aggressively working to kill one specific provision. In the middle, President Donald Trump, who has personally sided with crypto, met with Coinbase CEO Brian Armstrong at the White House and publicly told banks to back down. And the clock is ticking. The window to pass this legislation before the August recess is closing fast. This is the story of the Clarity Act, the most important piece of crypto legislation in history. And what happens in the next few weeks will affect every crypto investor on Earth. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data and research to help you understand how markets work. Always do your own research and speak to a qualified advisor before making any investment decisions. Let's start with what the Clarity Act actually is. Right now, the crypto industry operates in a legal gray zone. The SEC and CFTC, the two main U.S. financial regulators, have been fighting over who has jurisdiction over different digital assets for years. Crypto companies never know whether their tokens will be classified as securities or commodities. They face enforcement actions rather than clear rules. And institutional investors, pension funds, sovereign wealth funds, insurance companies, are largely sitting on the sidelines because they cannot operate in a regulatory environment this uncertain. The Clarity Act changes all of that. It creates a clear legal framework for how digital assets are classified, who regulates them, how they can be traded, and how they can be held in custody by financial institutions. If it passes, banks and traditional financial institutions can fully enter the crypto market for the first time, with regulatory clarity that protects them legally. That opens the door to trillions of dollars in institutional capital that is currently sitting on the sidelines. Ripple CEO Brad Garlinghouse has estimated the odds of passage at 80 to 90%. Treasury Secretary Scott Bessent has described passage as a spring 2026 target. The White House has been the most vocal institutional supporter of the bill. So if everyone supports it, why is it stuck? The single most contentious provision in the Clarity Act has nothing to do with token classification or regulatory jurisdiction. It is about stablecoins, and specifically, whether crypto firms can offer yield on stablecoins. A stablecoin is a digital asset pegged to a traditional currency, usually the US dollar. $1 in, $1 equivalent stablecoin out. They are used for trading, payments, and increasingly, as a savings alternative. The question at the heart of the Clarity Act debate is this: should crypto firms like Coinbase be allowed to offer interest or interest-like returns on stablecoins held by their customers? Coinbase says yes, and they have a powerful argument. If you hold cash in a money market fund, you earn yield. If you hold cash in a high-yield savings account, you earn yield. Why should holding a dollar-pegged digital asset be any different? For Coinbase, this is not a philosophical question. Stablecoin-related revenue represented close to 20% of Coinbase's total revenue in Q3 2025. The ability to offer yield on stablecoins is central to their business model, but banks say no. And they have a powerful argument too, though a less flattering one. Their argument, allowing crypto firms to offer yield on stablecoins, creates unfair competition for traditional bank deposits. If customers can earn 4 or 5% on stablecoins held at Coinbase while earning 0.5% on a savings account at JP Morgan, money will flow out of banks and into crypto. Banks call this deposit flight, and they say it threatens financial stability. Coinbase CEO Brian Armstrong has been blunt in his response. He described the yield restriction as a provision designed to protect bank profits rather than consumers. Trump has been equally direct. After meeting with Armstrong at the White House, he posted publicly, "The Genius Act is being threatened and undermined by the banks, and that is unacceptable. They need to make a good deal with the crypto industry because that's what's in best interest of the American people." The day Trump posted that, Coinbase shares surged 15%. JP Morgan shares fell. Markets are watching this very closely. So, where does the bill stand right now? As of the end of April 2026, the situation is this. There is an agreement in principle, but no final deal. The compromise being discussed would ban yield on stablecoins that look and act like insured bank deposits, but would allow crypto firms to structure rewards programs that function more like credit card cashback incentives. You earn rewards for using the stablecoin, not interest for holding it. It is a subtle distinction with enormous practical implications. Coinbase's chief legal officer expressed confidence in early April that a compromise on reward structures was imminent. But then the process stalled again. Republican Senator Tom Tillis, a key negotiator, told reporters that earlier hopes for April progress had slipped into May. Another 2-week delay while banks continued pushing back. More than 120 crypto firms, including Coinbase, Ripple, and Circle, signed a letter to Senate leadership demanding a markup be scheduled as soon as possible. The Blockchain Association sent 21 executives to meet with 24 Senate offices specifically on the disputed provisions. The Digital Chamber sent its own letter on April 20th, demanding the bill move to a formal markup stage. The White House Council of Economic Advisors is reportedly preparing a study concluding that the risks of deposit flight have been significantly overstated, which would hand a major tactical victory to the crypto side. But time is the real enemy here. The Senate Banking Committee markup has been pushed to May. Once scheduled recesses are stripped out, the Senate has approximately 9 to 10 working weeks before the August recess to move this bill. After August, the midterm election cycle begins heating up and legislative windows narrow dramatically. Treasury Secretary Bessent has described the urgency clearly, citing the 2026 midterm elections as creating pressure to pass this before Washington becomes consumed by electoral politics. If the markup happens in mid-May, the bill could theoretically reach a full Senate floor vote by June or July, be reconciled with the House version, and land on Trump's desk before the August recess. That is the optimistic scenario. It requires everything to go right in a city where things rarely go right on schedule. Let's connect this directly to what it means for your portfolio. The Clarity Act is not just a regulatory technicality. It is the key that unlocks institutional money at a scale the crypto market has never seen. Right now, most pension funds, insurance companies, sovereign wealth funds, and large institutional asset managers cannot meaningfully invest in crypto. Not because they don't want to, but because their legal and compliance departments cannot operate in a regulatory environment without clear rules. Their mandates require regulatory clarity before they can allocate capital. The Clarity Act provides that clarity. Once it passes, the compliance barriers that have kept trillions of dollars on the sidelines begin to fall. Consider the numbers. Global institutional assets under management total approximately $120 trillion. If institutional investors allocate even 1% of their portfolios to digital assets, which is conservative given that many allocation models suggest 2 to 5% for alternative assets, that represents $1.2 trillion of potential new demand entering the crypto market. Bitcoin's entire market cap is currently around $1.5 trillion. The potential institutional inflow from Clarity Act passage is not a marginal event. It is a structural transformation of the market. For Bitcoin specifically, institutional adoption increases demand while supply remains fixed at 21 million coins. The price implication is direct and significant. For Coinbase specifically, passage of the Clarity Act with stablecoin yield intact is worth potentially billions in annual revenue. The 15% share price surge on Trump's pro-crypto post tells you exactly how much the market thinks this provision matters. For stablecoins, USDC issued by Circle, which is Coinbase's stablecoin partner, becomes a regulated, yield-bearing financial instrument available to institutional investors. The total stablecoin market, currently around $240 billion, could grow by multiples if institutional demand is unlocked. For the broader crypto market, regulatory clarity reduces the risk premium that depresses crypto valuations. When institutional investors can participate with legal certainty, they bring not just capital, but also market depth, liquidity, and stability. Volatility decreases. Valuations re-rate upward. Signal Markets always presents the full picture. Here are the genuine risks that could derail passage. Risk 1. Time. The 9 to 10 week window before August recess is tight with competing legislative priorities. Budget reconciliation, FISA reauthorization, must-pass spending bills. The Clarity Act could simply run out of calendar space. Risk 2. The banks don't back down. Traditional banks have enormous lobbying power and deep relationships with Senate Republicans. If key Republicans continue negotiating indefinitely, the bill could die in committee. Risk 3. Democratic opposition. Several Democratic senators have flagged concerns about consumer protection and the treatment of decentralized finance. Their votes may be needed for passage, and their conditions could complicate the final text. Risk 4. A watered-down compromise. If the stablecoin yield provision is completely eliminated to satisfy banks, Coinbase and the crypto industry may withdraw support. A bill that passes without the yield provision is significantly less bullish for crypto markets than the current version. Here is the single most important indicator to track over the next 30 days. Watch for the Senate Banking Committee markup date announcement. The moment a specific markup date is scheduled, not discussed, not agreed in principle, but actually scheduled on the Senate calendar, that is the signal that passage is likely. Markups are the formal legislative process of finalizing a bill's text. Once scheduled, bills typically move forward. If May passes without a markup date being set, the August recess window is in serious jeopardy, and passage before year-end becomes significantly less likely. Watch the news from Senate Banking Committee Chairman Tim Scott's office. Watch Brian Armstrong's posts on X. He has been the most vocal and transparent public voice on the negotiations progress. And watch Coinbase's share price. It has been functioning as a real-time prediction market for Clarity Act passage odds. To summarize the key signals from today, the Clarity Act is the most important piece of crypto legislation in history, creating clear regulatory rules that could unlock trillions in institutional capital. The single disputed provision is stablecoin yield. Crypto firms want it, banks are blocking it, and Trump has sided with crypto. The window for passage is 9 to 10 Senate working weeks before the August recess. The clock is running. Passage would be the single most bullish structural catalyst for crypto markets in years, potentially $1.2 trillion or more of new institutional demand. The signal to watch: Senate Banking Committee markup date. Scheduled equals likely passage. Delayed equals serious risk. If this kind of analysis, connecting legislation, institutional money flows, and what it means for your crypto portfolio is useful to you, subscribe to Signal Markets. New video every week. No noise, just the signal. Link to our recommended platform is in the description below. As always, do your own research, and nothing in this video is financial advice. This is Signal Markets. Find the signal, ignore the noise. See you next week.